Hello, everyone. Welcome to this week's Investment Trends, where we discuss the latest news in the stock market and the economy. Today, I'm thrilled to be joined by John McKay. He's a chartered financial analyst and our portfolio manager here at Incline Wealth. We have a couple different topics that have been making news so far this year in the market, and we're excited to dive into those. So first and foremost, what we wanted to address was the sell-off that was in the market and how that led to a little bit of shockwaves through what had been a great prior 3 years for all three major indexes. So, John, if you wouldn't mind discussing kind of what we saw so far this year in the market, what that has looked like and a little bit of a sell-off.
Yeah, absolutely. And just to get in front of it, fundamentals have been sound. When we look at the conflict in Iran, and specifically once they blockaded the Strait of Hormuz, we saw the quickest spike in crude oil prices in the history of financial markets. And crude feeds into everything. It's energy, it's plastics, it's transportation. So that uncertainty really caused a lot of disruption in the markets.
Yeah, and we definitely saw that. Obviously we saw the spike in crude. It was great for some of the energy positions, energy stocks that we have within our portfolio. That was obviously a big fear in and of itself. What could happen and what would be the trickle effects as far as pricing, possibly inflation, with that constraint in the oil supply.
Yeah, absolutely. And with that, again, that uncertainty, the market just has no patience for. And you would see that a headline comes out saying there's a potential ceasefire. Immediately, we get buying in the market. We get some positive momentum.
Right.
And then Iran might come back, say that isn't the case, and all of a sudden there's a sell-off, and that's really the market's trading headlines, not balance sheets.
Yeah, absolutely. And what we also saw, earlier this year was new innovations, new updates to artificial intelligence that potentially posed a threat to a lot of the software companies. A lot of those Magnificent Seven stocks that had great years leading up to 2026 were in a bit of a sell-off as well. Some of them probably undeserving, right? Because their business, like you mentioned, their fundamentals were great. Businesses were still intact, and they kind of got swept up in the big washout that we saw earlier this year. Anything you'd add on the kind of the software companies that we've seen and some of that led to the sell-off as well?
Yeah, I think when you really think about Anthropic's Claude product, that was one of the catalysts, kind of their, they call it vibe coding. So being able to build out cheaper software internally than paying a pretty steep subscription to Salesforce or Workday.
Yep.
And it's great on the front end when you're developing that product. The issue is going to come when you've got to fix those bugs and you don't have that team internally. So I do see some upside. I think maybe a little pullback in software was warranted, but yep. I don't think it's an apocalyptic situation for that industry.
Yeah, absolutely. And that kind of brings us now to topic number 2, right? So what we have seen this week, as of Wednesday, tax day, April 15th, with the S&P approaching and hitting a new record high. So thankfully, we've seen a pretty strong recovery.
Yeah, absolutely. And looking at EPS growth year over year rather, expectations are from 12.6 to 19% for Q1, which is incredible. That would be, I think, 6 straight quarters of EPS growth, which, it's a great sign for a resilient economy.
Absolutely. Yep. Yeah, and one thing to note is we saw a similar correction last year, right, around tariffs, around Liberation Day, and the announcements there, to where the market saw a double-digit downward turn, right? We saw it drop by almost 19%, in April, and there we also saw a pretty quick recovery.
Yeah, and this year it was actually a quicker recovery. About 10 days, we made up 9.8% of
Wow.
trading losses.
Yep. Yeah. So yeah, that was that was a great sight to see. One of the things about the market returns that we've seen this year, and I previously I'd mentioned the Magnificent Seven, and how much that accounts for the overall percentage of market movement, but seems like some other companies are joining the party, right?
Yeah, we're seeing more breadth in the market. So you're seeing industrials really having a great year so far, and expect that to continue on.
Yes. So what we've seen, and we saw within that equal weight index, a lot of those companies that have a lot of hard assets or maybe resilient to AI, they started to step in and participate in a lot of these rallies that we've seen. You mentioned industrials, infrastructure. So a lot of these companies like Caterpillar, right, had a great year, and they were also propping the market up from even potential more losses.
Yeah, absolutely. And we also saw resiliency in financials and healthcare. Healthcare's kind of been touch and go with some of the Medicare and Medicaid premium growth numbers that the government is giving. Initially, I believe it was 0.5% that they were going to allow that growth in revenue, and it's now jumped to about 2.5%.
Yep.
So it's not where it was a year ago, but it's more positive than it has been for about 6 months.
Yeah. Yeah, those are all, again, like we mentioned, great signs for an overall strong economy. And like we said, it's recovered. It's made up for the losses that we saw earlier in the year, and knocking on the door or surpassing a new all-time high. So something to keep in mind. And then it brings us to our last topic of the day, which we could talk about for hours, but to keep it brief, really is AI and jobs. So we're approaching earnings seasons this year. We're starting with the banks this week, and we are starting to hear on more and more of these earnings calls the mentioning of AI and companies implementing this, starting to become more AI efficient. So what are some of the things you've been reading about or seeing, as it relates to AI?
Yeah, so a big concern for a lot of people has been AI eating into jobs. In Q1, we saw about 80,000 tech workers displaced, and about half of those have been attributed to AI. Listening to Mark Andreessen this week, he kind of uses AI as a silver bullet. It's not really driving the loss, but
Yep.
It's a great excuse for executives. Looking at tech, there's estimates between 25 and 75% overemployment in tech. So it's kind of a normal corporate restructuring,
Right.
but it looks great to the street if you say, oh, we have this great efficiency that we're getting from AI. We're going to roll that out, and this is what's going to happen to our numbers. So
Yeah.
I think there is a lot of growth that's being developed through AI, but I don't think it's going to have the same effect on jobs that is being reported.
Yeah, because there obviously needs to be some of that checks and balances, right? Someone has to be there to be a critical thinker, in compliance, making sure that the information that they are seeing and that they're reading and that AI is producing is correct. There still is a lot of that human need that goes into problem resolution, relationship building, and some of the critical thinking to make sure that they know what they're producing and what they're using in some of these models or the code that it's generating. So something to keep an eye on. Again, I agree with your point, John, that there was probably a little bit of overemployment, and companies are more so using it as an excuse for what would have been normal turnover within the company anyway. So again, great topics. That's what we've got for this week. And again, glad to see the market rebounding so quickly. Looks like there could be, we'll continue to monitor as more and more companies start to report their earnings. And obviously, the AI shift continues to be updated very rapidly. So That's what we've got for this week. Thank you for tuning in. If there's any certain stocks or sectors that you're looking at, leave a comment below.